another update. So I'll keep this update very short. It's a Sunday. And in general, nothing has changed much in the market in the last 14 odd days. It is just that market has now entered a phase of consolidation, a phase of pullback, nothing that you haven't seen before. But it is important that you pay attention to what is happening and in which pockets you have to pay attention. The first pocket is that of capital market. Capital market index has had a beautiful uptrend. We are now entering a phase where a new base is getting formed, still a rising 50 DMA, beautiful relative strength. This is the previous RS base marking. All you have to do here is go behind those stocks in capital market index that you understand. There are limited stocks here. Some stocks are pulling back again to 50 DMA. Today, there is a lot of talk about gold and silver moving up. You look at the chart of gold in the last 3 years, you will see a repetitive pattern. A pattern is price moves up, pulls back to 50 DMA, forms a new base, and again moves up. So, whenever you see pullback happening in the market, the news flow is not going to be good, especially related to capital market with what came out with a particular trading firm and what SEBI investigated about. So these sentiment driven events will always make you relatively short term in the market. And that is what a big mistake majority of investors and traders commit. So look into the capital market space. It's again giving you a beautiful opportunity. Let it come back to 50 DMA. Let it form a new base. There are a lot of stocks that will give you opportunity here. The next pocket is banking sector. Within this, both private and actually now PSUs have also started performing. If you look at the banking sector, it is refusing to fall. Again, a rising 50 DMA, beautiful relative strength. Look at all stocks in this pocket, especially the smaller names. The smaller names are ones that are going to give you more alpha. The bigger names are ones that are going to move up and will give your portfolio stability. So you can have a mix of large cap banks and smaller banks. The smaller will again give you alpha, large cap will give you stability. The next pocket is defense sector. Again, we have seen a vertical rise, beautiful relative strength. Now it is pulling back. A lot of stocks have fallen 10-15%. Short term hands have got shaken out. Now it is your opportunity to start buying stocks in this pocket and all the pockets that I'm discussing, and have a gradual approach. Market is not ending tomorrow, trend is not ending tomorrow. You can buy a couple of shares every day or whatever your account size permits. But slow and gradual accumulation is what wins in the stock market. The next pocket is financial services. In financial services, there are subcategories also. One was capital market, then broking is there, then you have life insurance, general insurance. I'll come to that in a bit. But again, beautiful relative strength. It is stabilizing, rising 50 DMA. This consolidation that is happening within a structure of higher high, higher low. So this is an exceptionally strong pocket. Make sure you're using the recent dip in the market to accumulate. And whatever I'm stating here is from the medium term point of view. I have nothing to do with the next 1 week, 1 month, 2 month. Market can remain volatile. We can go down 3, 4, 5%, and still the trend won't change. So whatever I'm speaking about is from a medium term point of view, which I would define as something between 6 to 8 months from today. This is the hospital sector. Look into this pocket. Look at the beautiful movement that is happening. Again, look at the relative strength. This is one pocket you should not miss. I will have a detailed video on insurance and hospitals soon, maybe next week or one after that. But look into this space. There are some stocks that are doing exceptionally well. And if you zoom out and go to the higher time frame chart, it just appears that the rally has just started in some of these stocks. The last space, this is the insurance sector. Actually, this was the insurance sector. This is the hospital space. So again, a beautiful rising relative strength. You don't have standard indices for these pockets. So that is why you have to create one using TradingView. It's not that difficult at all. But again, a clear higher high, higher low structure here. Rising relative strength. Now it is consolidating. The insurance pocket and the hospital pocket is kind of a dark horse in the market. That is a pocket that is not generally looked at that much, but majority of stocks are moving together in these two pockets. So these are the only 5-6 pockets that I'm paying attention to. My portfolio comprises, 85 to 90% of my money is in these pockets, diversified across these pockets, because even if a couple of pockets end up doing very well, your portfolio performance automatically heads up. Now I will open up 3 charts and speak something about short-term swings in the market. I'll read a few things that I've directly copied from some books on behavioral finance. Some of the text is from William O'Neill, some is from Stan Weinstein. I'll just read few things out so that you understand why this short-term mentality in the market will always keep you anxious and will not help you grow your account. So you have to revisit these slides in case we see a deeper pullback in the market. Let's say we go down 5 7%, come back and read these slides again. What does history teach you? Despite overwhelming evidence that patient long term investing builds wealth, most investors remain hypnotized by short term price swings. This addiction to short term noise has deep psychological and structural roots, and it explains why many fail to capture the life changing returns that long term trends offer. Again, this is all due to media, social media, your friends, you're discussing a lot of things about markets with everybody. You're looking at charts quite frequently. That is why short term trends will always impact you in a negative way. The Satta Bazaar mentality versus buyer business mentality. The Satta Bazaar, if you speak to anyone who is in the market since 1980s, 90s, 2000, stock markets were always defined as Satta Bazaar, that is speculation. Again, because of short term nature of people in the market. Holding a stock for 10 years, in contrast, provides no daily thrill, only uncertainty and anxiety in the face of constant price fluctuation. This means that if you buy a business from a long term point of view, that is still the trend is intact, you will not get those daily thrills that we are all used to, the dopamine effect that we get in the brain. That you can only get through Satta Bazaar mentality, and that is why majority of people are in this kind of trading behavior in the market. And this is why the point that I mentioned, that 80s, 90s, 2000 people will always remember stock market as a Satta Bazaar, because generally that is what the population goes behind. You look at the recent findings from SEBI with respect to FNO. Again, 91% people are losing money, and yet you look at the volumes in FNO as opposed to equities. You'll get the answer for this. The human brain, understand this, is hardwired for action. Humans evolved in an environment of immediate threats and rewards. This wiring drives the need for immediate feedback and quick wins. You ever met a real estate investor? A real estate investor in general will do better than a stock market investor, average investor. And the reason is, in real estate, when you buy a property, you cannot do a right click and exit that property. There are a lot of fluctuations that happen in real estate as well. But because stock market gives us a direct portal to right click and exit everything, just because of our brain being hardwired for action, this is detrimental for a stock market investor. So the stock market in general will always constantly update prices, feeds this instinct perfectly. Each tick provides a dopamine hit, like pulling a lever on a slot machine in a casino. That is the reason why I always suggest that don't look at your portfolio every 5 minute, 10 minute, 15 minute. It just does not help. My long term portfolio, I check it once at 10:15 a.m. and then only in the evening. Especially on days when the stock market is correcting a lot, Nifty is down 2%, I don't even open my long term portfolio, because I know that I will get impacted by seeing some stock that is down 13%, 15%. I'll give you a real example. This time around, whatever stocks I have about 24 stocks that I'm still building my portfolio around, especially after the correction got over. I still have about 30% cash to deploy. But in whatever money I've deployed in the market, there are six stocks or five stocks that are down 15 to 20%. If I look at those stocks every day, naturally I will be inclined to exit positions and reallocate to some newer structures. So understand this difference. The short-term mentality kills your account. You also have to understand the cycle of media and analyst. So you have an initial uptrend, then people start disbelieving that uptrend, then the euphoria kicks in. So defense started, capital markets started, banks started. The disbelief was there because the broader market environment was not good. Then the euphoria came in the last phases where defense and capital market have had a vertical up move in the month of March and May. Then the media catches that trend. Then the people, a short-term trend push comes in, and then the pause and the pullback happens. So this is precisely where you have to start re-looking at it. This is not the place to get into extended sectors. So this is a cycle again. Just take a screenshot of it. This is where a lot of people start going wrong. You also have to understand, this is a slide from behavioral finance, which means how humans influence the stock market through their behavior. The comfort of pain and loss. Again, just give me a couple of minutes, I'll read it. Behavioral finance studies show that losses hurt about twice as much as gains feel good, a phenomenon known as loss aversion. This drives investors to react strongly to short term drawdowns, even if fundamentals remain strong. I will still tell you, our market is heading higher. Our fundamentals are fine. Liquidity is abundant in the system. Inflation is under control. There is serious concern about corporate earning. Always be worried when everybody is happy about the earnings. Don't be that worried when everybody is concerned about earnings. Market will automatically adjust. Market is intelligent enough. Instead of viewing dips as opportunities to add, they panic and sell. Ironically, the greatest wealth in the market often accrues to those who can endure these drawdowns and stay invested through entire market cycles. Now, this does not mean you hold on to a portfolio that is down 50% or 60% and you don't make adjustments. This means that a normal range of stock market in current scenario, I would say, can easily fluctuate between -7 to +7%. If you can't endure such drawdowns, I have a hard limit of -7%. If I see -7% or more, then I start making serious adjustments in my portfolio. That is just a level I'm comfortable with. I know some people who are comfortable with -25% also. There are some people who are comfortable with -40 also. So you have to find out what that number is for you. Research shows that small handful of multi-bagger stocks generate the bulk of long-term market gains. Missing just a few can drastically lower your lifetime returns. This means whenever these short-term dips come in the market, do not touch your winners. Do not touch your winners, because you just don't know today which of those winners are going to become mega multi-baggers in the future for you and will drag your performance of your portfolio on the upside to a limit that you don't even imagine today. The first thing that people do is they start booking profits on winners. They don't touch their losers. It has to be reverse. If you see drawdown coming in the market and you don't feel comfortable about it, start cutting the loss making positions, but don't touch your winners. Don't touch your winners, because your winners will again form a new base and give you further opportunities to add to your existing position. So how do you break this addiction? This addiction of being hyper focused on shorter time frames. The first step is to acknowledge that you have a problem to correct. Instead of blaming the market, look inward. Are you hyper focused on shorter time frames? And you see, blaming others for your problems is human nature. You must have seen this in your offices, in your friend circle, in your family circle. This is a problem that majority of human beings cannot correct. That is to acknowledge that there is something wrong within them or within their process. See, remember one thing, that if you are seeing a stock that you hold that is falling, 5 odd percent, and you check a 15-minute or a 60-minute time frame chart, you see big red candles on that chart. Just zoom out and check the monthly and weekly. It will be a small blip. So the problem here is too much of attention to shorter time frame movement in prices. So the solution is just zoom out. Study price charts in weeks, days, not in hours and minutes. Trends are more clearer when noise is filtered out, and higher time frames are the best for it. Screen time. The less you watch, the less you'll tinker. That is, you'll think less. The more number of breaking news data points you see, the more scared you'll be. Some data comes out on inflation, some comes out on tariffs, something happens. You have to limit your screen time. Read history. Study great investors like Warren Buffett, O'Neill, Peter Lynch, John Bogle. The greatest fortunes were built by patience, not by prediction. Shorter time frames are generally used by those who want to anticipate where the market is going to move over the next 1 week or 10 weeks, or that is 2 weeks or 15 days. That is just not useful for you. If you're here to build wealth, then higher time frame is the only thing that you have to worry about. And then, yes, read about these great investors and traders who have built wealth using long-term trends. And automate the discipline process. This means the greatest tool for retail investors and traders is to accumulate gradually, to look into strong sectors and pockets and buy when dip comes about. Today, dip is happening in the market. Consolidation is happening in the market. Buy in a staggered manner to make time and volatility your friend. If you want to buy 500 shares of some defense company, buy 50 today. Buy 50 next week. Another 50 probably next week. In over 7-8 weeks, try and accumulate 500 shares in a particular company. Or a complete portfolio, which I term it as a systematic trading plan, which is every week you're deploying fixed amount of your capital into a portfolio of stocks. This is the slow, gradual way of accumulation. And once you go through this cycle of STP, and if some of my members are here listening to this video, can you please share feedback about the STP method that you guys are being doing in this market and how it helps, especially people who are new and who are too much bothered about shorter time frames, how STP wonderfully works for you. So for investors, that is SIP. For traders, it is STP. It is the greatest method that a retail investor can have for himself. That is slow, gradual accumulation in strong sectors, strong pockets. That is when the dip is coming in the market. So I'll see you guys next week. In case there is a video to be made, I'll definitely make it. Else, I'll see you one after that. So take care, be safe, and have a wonderful weekend ahead.